Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder of LikeFolio. Thanks for joining us, Landon.
Hey guys, thanks for having me.
All right, we're talking used cars. CarMax reporting earnings tomorrow. Stock's down over 20% so far this year, Landon. And it seems like a lot of the data is saying that used car prices topped out last month. What kind of data are you seeing? Is the consumer still looking for used cars?
Yeah, what a wild time to be a used car dealer. I mean, you go from basically, you're trying to flip a depreciating asset by underpaying on when you're buying and overselling on the price, to now all of a sudden, or at least a year ago, your depreciating asset is an appreciating asset, but they're hard to come by. It's just a crazy time. They made a lot of adjustments. They almost doubled the amount of cars that they bought, and the amount of cars that they sold went up by about 30%. So all of that really comes back to the chip shortage, and it has driven up used car demand across the board. It's not just CarMax, it's all of them. And that's because it's really hard to get a new car. And so used car is the next best option. If you're talking 1 or 2 years old, really, what's the difference between that and a new car? So many people had that idea that, it drove people into these used cars. And I think that, they had a wild ride from March of 2020 up to November highs, and now they're back down. I think they're around just over $100 now, a third off of their highs, CarMax, that is. And the data for us is kind of saying that, CarMax is slowing down a little bit. I think that, it's consistent with what you're seeing. The used car market is doing well. Prices are higher. There's concern for chip shortage. All of that is still there, but their consumer demand is slowing down a little bit, at least the growth of the consumer demand. I think that's really the key. So they're still increasing, but not as fast as they used to, and actually not as well as their competitor, Carvana. And that's kind of, where I would lean if I was forced to take one of these two longer term. The difference is very clear. Carvana, this is that scatter plot that we love to put up. To the right is more demand, and higher is happier customers. So you want to be up and to the right, not down and to the left. So CarMax is lagging a little bit. They're in an industry that's being, like I said, it's all kinds of crazy turmoil going on right now. And they've been handling it pretty well. But I think expectations have gotten ahead of themselves, and people are starting to wonder, maybe this is the top for used car prices. Because one thing I think we can all agree on is when those chips start flowing and they get put into all these cars that have been made and are waiting on chips, then all of a sudden a used car is going to have zero appeal, because there's going to be lots and lots of new cars available. So it's not an attractive thing to be sitting on huge inventory. They've got to move them. They've got to keep that pace up, and they're going to move from appreciating assets back to normal depreciating assets. So I'm concerned about the company longer term. I like Carvana better. On this report that's coming up, we've got a -16 on CarMax. Again, that goes from -100 to +100. Kind of bearish, but not maybe firm enough to take a position. I'm more in the avoid camp on CarMax on this report.
Yeah, it's interesting, Landon. CarMax probably loves some of the metrics that are out right now in terms of demand for used cars and overall used car prices, but, and that's a big but, what I've read about CarMax is they like to keep their gross margins right around 2,200 to 2,400, and they don't really deviate from that. And so with used car prices going up, trade-ins are probably at higher prices. You're right, Landon. You don't want to be sitting holding a bunch of high-priced inventory when this big game of corporate musical chairs, if the music stops and those chips start flooding into new cars, you don't want to be holding a bunch of inventory at inflated levels. So there's some frightening aspects of this used car market right now. And then they've got all the other things with supply chains and labor costs going up and things like that. So inventory is so vital for them to keep used cars coming in and going out. Yeah, you're right, Landon. This is a scary time to be in the car business. Now, they'll manage it. They'll navigate it like good companies do. But it could get a little bumpy here along the road. Right, Landon?
I agree, yeah. And if you look at everything has been benefiting them. The average retail selling price of a used car was up about 31% year over year last quarter. The number of units that they sold was up 17%. You combine that, they had a great quarter. I think their revenue was up 60-something% last quarter. So they're doing well. They're taking advantage. Their mobile application is better. They're doing a lot of the right things, but they can only control what they can control. And once those chips come in, it's going to be the complete reverse. Why would you want a 1-year-old car when the new ones are completely flooding the market and it's got all the features, bells and whistles, and all of a sudden the prices of that 1-year-old, 2-year-old car are going to just plummet. So I'm not saying anything that CarMax doesn't know. They know this. They're moving cars. They sold more last quarter than they bought by about 10%. So they're moving their inventory down, but they're still, it's still a liability. It's still an issue, and they want this chip shortage to last as long as possible, I would imagine. But there's other players that are fighting the other direction. You guys were just talking about NVIDIA, one of my favorite companies longer term. There's a lot of companies wanting the chip shortage to end as soon as possible. So we're going to see who wins on this one. In the end, of course, it'll be the consumer. But I would be weary if I was shopping for a new car right now. If I was shopping for a car right now, I probably would wait because I think the chip shortage is probably going to be over sooner rather than later. And CarMax could be in trouble there.
See, I think the opposite, Landon, and I think a perfect example is NIO. They said they still have supply chain issues. Sales slowing down in China, and Tesla maybe has too many due to those supply issues that we talk about. But when you look at that, on your chart that has the mentions count, the used vehicle mentions count, do you see it rolling over? Because I look at the very tail end on the far right side, and it just seems like to me that, hey, consumers are getting priced out of everything. Savings rates are going down. Their ability to buy even a used car right now is going away. And then you tack on $5 or $6 a gallon gas. That doesn't bode well. So is it rolling over there on the far right?
It's slowing down a little bit. But if you look back on that chart, there were several times where it looked like it was slowing down and then it surged back higher. So it's at all-time highs right now for sure. It's a little sideways over the last few weeks, but we'll see where it goes from here. And I think that where that goes, that used vehicle demand, is where CarMax and Carvana go. But back to that comparison, if you're going to be involved in one of these companies, why not pick the better one? And I would say Carvana is better. Their earnings score is plus 32 right now. We're more bullish on them. Their happiness is higher. CarMax is around 57. Carvana is around 64, doing much better. Leaving out the company Vroom, they are looking absolutely horrible. Happiness is actually, I think, our lowest company at 29. They're lower than Spirit Airlines, which is a first, I think. So just VRM, I would avoid that one. But Carvana, I like. CarMax, kind of staying away from.
Gotcha. And if your score is negative for this one, Carvana's higher, according to your data. But at the same time, if you look at Carvana's stock price, it's down over 50% so far this year. That one's been a falling knife, but you do like that one better, right?
Yeah, I think so. I think that's another consideration. So a lot of our data doesn't really think about or doesn't consider too much the stock price. And so if you've got a bullish data outlook and the stock is down, you could, visualize that as a opportunity, a divergence opportunity. It's always easier, at least for me, to buy one when it's pulled back a little bit if our data kind of tells me something that maybe the market doesn't know yet. So I would be more inclined to go that route. I know that a lot of people are in the buy high, sell higher camp, and I totally get it. I like to follow the data. If it's really strong, I'm a buyer either way. I'd prefer it to buy it on sale, but I get that either way.
By the way, just from full disclosure, researching new cars, 4 to 6 months delivery time right now for, you pick out a car, you add some stuff you want on it. So there's still a lot of supply chain issues right now. All right, Landon, great stuff as always. Thank you.
Thanks a lot, guys. Take care.
All right, that's Landon Swan, the co-founder of LikeFolio, joining